What does refinery utilization, an EIA, report signal for energy supply? Imagine a busy highway during rush hour. The cars representing crude oil being processed at refineries. When traffic is heavy, it shows high demand. When it slows down, it hints at less activity. Refinery utilization works the same way in energy markets. It measures how much of a refinery's capacity is being used to process crude oil into fuels like gasoline and diesel. The U.S. Energy Information Administration calculates this by dividing the actual crude input into atmospheric distillation units by the refinery's maximum capacity. This number tells us a lot about current energy supply and future trends. When refinery utilization rates go up, it signals that refineries are working near full capacity. This usually means strong demand for fuels, often because of seasonal factors like summer driving or winter heating needs. High utilization can also mean that crude oil supplies are tight, which might push crude prices higher. On the other hand, if utilization drops, it suggests weaker demand or excess supply. This could happen during economic slowdowns or when fuel consumption declines. Lower rates might lead to falling crude and fuel prices because refineries are not processing as much oil. In the United States, refineries typically operate between 80 and 100% utilization. This range depends on the time of year and economic conditions. During peak summer months, utilization often reaches the higher end because of increased gasoline demand. In winter, it may dip slightly due to lower fuel needs. Refineries cannot run below about 65 to 70% without risking damage or losing product quality. This limit is called the turndown rate. For investors watching energy markets, refinery utilization offers important clues. Rising rates often precede tighter crude supplies and higher fuel prices. When refineries operate at or near full capacity, they pull more crude from the market, supporting crude prices. Conversely, falling utilization can signal slowing economic activity or less fuel consumption, which usually pushes prices down. The EIA releases this data weekly through its Petroleum Status Report, giving traders a timely view of refining activity. This weekly update helps investors adjust their strategies based on real-time changes. Seasonal patterns also influence utilization. Summer months see higher rates due to increased gasoline use, while winter months focus on heating oil needs. Unexpected events like maintenance shutdowns or supply disruptions can cause sharp drops in utilization. When refineries undergo planned maintenance or unexpected outages, refined product supply tightens, which can lead to higher prices. When refineries resume operations, utilization rates recover, increasing fuel supply. Monitoring refinery utilization helps investors understand the balance between supply and demand. When combined with crude oil inventories and product stocks, it paints a clearer picture of market conditions. High utilization with low inventories often signals bullish trends, meaning prices could rise. Conversely, low utilization with rising inventories suggests bearish trends, with prices likely to fall. Keeping an eye on this metric allows traders to anticipate shifts in energy prices and better navigate the complex energy market landscape.